Trying to trade or invest in financial markets without understanding at least the basics of macroeconomics is literally like trying to sail a boat without understanding the wind and the sea. And I see far too much content online that completely overlooks this absolutely crucial, fundamental factor that drives market prices up and down. And it needs to be in the knowledge base of every single trader and investor there is out there. You have to understand these macroeconomic fundamental drivers which move markets in the long term. You have to. So in this video, I'm going to explain the key, simple but crucial macroeconomic variables and data points you need to tune in for. Specifically through the lens of financial markets. So I'm not going to bore you with supply and demand curves. I'm not going to bore you with classroom economic theories. This is simply the data you need to be aware of and the outlook you need to be aware of to understand its influence on financial markets. Hi, welcome to episode 3 of the Introduction to Financial Markets playlist. Please know I post videos to this playlist every single Wednesday to, as the name implies, introduce you to financial markets. If this is something you think you could take value from, please consider subscribing. So to jump straight into it, what you need to understand about macroeconomics, and specifically through the lens of market analysis, is two fundamental variables. The two big things you need to look out for when analysing a macroeconomic backdrop through which financial markets are based on is two things: growth, inflation. Inflation and growth, growth and inflation. These are the two big things you need to look out for because they have an enormous influence on the stock market, on the bond market, on FX, and on commodities as well. These really influence the price of markets. They drive market sentiment one way or another, and you need to know what's happening with them to understand why markets are behaving the way that they do. Or the way that they are, I should say. So, to briefly explain what these two things are, growth is essentially the strength of an economy, right? It's activity. It's, as the name supplies, it's growth. Is the economy growing? Is it stagnant or is it decreasing? Okay? It's the strength of an economy is another way you can colloquially refer to growth. When an economy is strong, it's growing. There's more activity, there's more consumer and business activity, there's more buying and selling, there's more produce, more stuff happening basically. Inflation has everything to do with the prices in that economy, right? So are prices broadly across the economy going up? Are they stagnant or are they going down? That's what you need to understand. That's what growth is, that's what inflation is at a very, very basic elementary level. So how do you know what's going on with growth and what's going on with inflation? What do you need to look out for? Well, data points like this are released every single week, month, and quarter on the economic calendar, which really allow investors and economists and institutions to understand the economic outlook so they can adapt their policy or investments accordingly. So we're going to get into all of this stuff now. As I said, this is the key, crucial, fundamental drivers, at least in terms of the macroeconomic outlook, that influences stock markets, currencies, bonds and bond yields, and commodities. This is really important stuff that you have to understand to know which way the market's going to go, or which way it's currently going. Okay, so to start with growth, what you need to look at is consumer sentiment readings, business sentiment readings, retail sales. You also need to pay close attention to the labour market, and of course, the sum total of everything in the economy, which essentially quantifies the growth of an economy, quite literally, is something known as GDP, which you've no doubt heard of. And this is an acronym for Gross Domestic Product. And this figure is essentially the sum total of everything that was produced in the economy. So goods and services, manufacturing, stuff that was made. The sum output of an economy is quantified using GDP. So the GDP reading is incredibly important for markets and institutions because it literally quantifies if the economy is growing or shrinking or stagnant. Okay, so that figure is very, very important for markets because it indicates whether the economy is getting really, really strong, whether it's heading into recession, or if it's stagnant, whatever it is. GDP is without a doubt the most important indicator when it comes to growth, because it is the growth of the economy, okay? But this doesn't mean the other data points aren't in a way equally important, because these are the ones that come in every single month that go into the growth outlook. So when you have retail sales coming in really weak, business and consumer sentiment dropping, you have the labour market cracking, this usually implies that GDP is going to shrink. And as I said, GDP is usually released quarterly, whereas these other data points come in monthly. So on a month-to-month basis, it's very important to stay on top on, again, just to go through it for you, retail sales, labour reports, consumer and business sentiment. So that's the growth outlook for an economy, right? When an economy is growing, that means there's more, that's essentially more stonks, right? There's more stuff being made, there's more profits being turned, more people getting jobs. Things are better and stronger and healthier and growing in a strong economy. And of course, vice versa in a weakening economy. Okay? So when an economy is in recession, that's more people getting unemployed, it's retail sales dropping, that's less company profits. All not very great news for the stock market. Okay? So these growth readings are really important for financial markets, because when an economy is strong, generally speaking, there's a caveat to this I'll get to at the end of the video, when an economy is strong, that usually implies companies do better. Again, stick around to the end of this video, I'm going to get into the caveat on that. Vice versa, when an economy is shrinking, that usually means more businesses are going out of business, it means more people are unemployed, so they can't spend money in the economy. Financial markets usually crash in a recession, okay? So these things are incredibly important to understand when you think about your own trades, your own investments, all right? Tune in for growth and economic strength data. It's very important. So with inflation, as I said, this has everything to do with prices going up and down in the economy. This is how you quantify the price increase or decrease in an economy. And there's a few different ways to slice and dice this data. But the most important is the CPI index. So that's Consumer Price Index. And that is, I shouldn't say CPI index, because that's just Consumer Price Index. So it's just CPI. This is what's released usually first every single month. So this gives markets and economists and institutions the earliest warning on the current state of inflation in the economy. And on top of that, you have the core CPI reading. And this is when you strip that headline CPI, so the main CPI, you take out different sectors of it, like energy and food, because these are often very, very volatile. So you take away food and energy, and then you're still left with the sort of the domestic price increases or decreases in the core CPI reading. So with every CPI reading, you get headline CPI, total price index increase or decrease, and then you have the core CPI reading, which targets the domestic price pressures in an economy. Then you have PPI, which is producer price index. So this is how much companies and businesses, how much their prices are going up and down for things. And again, you also have the core PPI reading as well. In America, you also have things like the supercore inflation and the PCE deflator. But markets predominantly focus on CPI and PPI because those usually come out way sooner in the month and give us a much broader, faster preliminary understanding on what's happening with inflation. So what influence does this have on markets? Well, it has a lot of influence on markets, I'll tell you that, because central banks tune their policy according to inflation and inflation expectations. When inflation is running high, central banks increase interest rates to bring inflation back down. And this has an enormous influence on the economy. This really influences the price of the stock market. This really influences the prices of the stocks. This really influences the currency and bonds and commodities. This is a really big deal, okay? Inflation is incredibly important to tune in for. Okay, so that's a very, very hasty, speedy introduction to the subject. But just to clarify and simplify, growth and inflation, very important to financial markets because it really influences the economic outlook, which is what financial markets are truly speculating on. So the reason the stock market rises and falls is because of investors buying and selling stocks. And one of the key fundamental drivers of this is the economic outlook. Okay, so when we saw it last year, when the Federal Reserve said inflation's too high, we're going to increase interest rates, and we're going to do it damn quick, you saw the stock market crash. You saw it just absolutely fall down because people said, well, interest rates are going to be higher, that's going to slow economic growth, that's going to probably cause some problems in finance, as it did earlier on in this year. It's not good news for the stock market. That's why stocks were falling last year. That's what's really dominating the market narrative right now, is this macroeconomic outlook, specifically in America. So inflation and growth, incredibly important to tune in for, okay? This isn't a simple equation. Just because growth is strong doesn't mean the stock market goes up. And I think the perfect example I can give you of that is the retail sales report we had out of the US yesterday. So strong US retail sales were announced yesterday. And the stock market fell. Why is that? Well, it's because of this caveat I said earlier on. Economics isn't simple. Okay, it's very contextual. One thing happening at a certain time is very, very different to a thing happening at another. And what everyone is looking at right now, what markets from Tokyo and China and Hong Kong all the way across Europe to New York and Los Angeles are looking at right now, or San Francisco I should probably say to be more accurate, they are all looking at what the Federal Reserve is going to do with its monetary policy. It is the key driver of markets right now. What is the Fed thinking? What is Jay Powell going to say at the next press conference? When are we cutting rates? Are there going to be more rates? This is what's really important to markets right now. And so the strong retail sales figure yesterday, although it was good news for growth, it implies more inflation, so a stronger economy creates more inflation, modern theory for you. But it also means, due to a strong economy, strong inflation, it means the Federal Reserve is likely to keep interest rates higher for longer, which is bad news for stocks, okay? So this isn't to confuse you, this isn't to say, well, if nothing makes sense at any one time, is it all pointless? And it's like, no, it's definitely important to understand this, okay? Because when you're using technical analysis to try and figure out which way an FX pair is going to go, I promise you, a CPI report is going to just knock you off your feet if you're on the wrong side of it. Okay, you have to tune in for growth data, you have to tune in for inflation data. This is what drives financial markets, okay? And it's contextual, it's detailed, it's nuanced. That doesn't mean it's impossible. So I hope you took some value from this video. Before you go, please know I post a video like this every single Wednesday to the Introduction to Financial Markets playlist, alongside weekend briefings of what happened in the week and briefings of what's going to happen next week. If this is something you think you can take value from as a trader or an investor, please consider subscribing. Thank you.